Shri Gurubhyo Namaha. Welcome to our online class. Today we are going to study about the investment function. In this, we are going to study in detail about what is investment function, the formula for investment function, the types of investment, that is autonomous investment and induced investment, and both autonomous investment and induced investment in the diagram. That is autonomous investment, how it is parallel to the x-axis, and induced investment, how it slopes upwards, and the difference between autonomous investment and the induced investment. Next, the factors which are influencing the investment function. Then, the difference between the rate of interest and the investment. Let us go in detail. Investment function. Meaning of investment. The term investment means purchase of stock and shares, debentures. What do you mean by debentures? I think already you would have studied about this particular word in accountancy. Anyhow, I'll tell you the meaning for this. Debentures is nothing but it is a type of an instrument or a department which are not backed by the collateral, and it has a term greater than 10 years. Clear? Then government bonds and equities. What do you mean by equities? Equities is nothing but fairness of the company. So, the term investment means purchase of stocks and shares, debentures, government bonds, and equities. According to Keynes, it is only financial investment and not real investment. This type of investment does result in an addition to the stock of real capital of the nation. In the views of Keynes, investment includes expenditure on capital investment. Investment function. What is the formula for investment function? I is equal to F into R. In this time, let us recall the formula for consumption function. C is equal to F into Y. Do you remember? Okay. Now, let us see the investment function formula. I is equal to F into R. That is, it is a functional and inverse relationship between rate of interest and investment. I is equal to F into R. I refers to investment, R refers to rate of interest. Now, let us come to types of investment. There are two types of investment. Number one, autonomous investment. Number two, induced investment. What is autonomous investment? Before this, let us go ahead what is the meaning for the autonomous and what is the meaning for induced? Autonomous is nothing but individual economic activity. Induced is nothing but planned economic activity. Autonomous investment means additional investment that is independent of income. Induced investment is nothing but additional investment demand that results from an increase in domestic product, that is in GDP, gross domestic product. Autonomous investment. It is the investment that is not dependent on the national income. It is mainly done with the welfare motive and not for making profit. Example, construction of roads, bridges, schools, and charitable houses. It is not affected by the rise in raw materials or wages of workers. It is essential to the development of the nation and it is out of depression. Autonomous investment. Autonomous investment is the expenditure on capital formation which is independent of the change in income, rate of interest, or rate of profit. This investment is independent of economic activity. Autonomous investment is income inelastic. Income inelastic. Are you able to understand? Inelastic. Slow in reacting. Slowly. Okay. The value of autonomous investment is the same at all the levels. The autonomous investment curve is horizontal parallel to the x-axis. See the diagram? This is the investment. It is parallel. This is investment axis. This is x-axis. This is y-axis. X-axis is expressed in income. Y-axis is expressed in investment. And this investment is parallel to the x-axis. Okay. Next, induced investment. Induced investment is the expenditure on fixed assets and stocks which are required when level of income and demand in an economy goes up. In the economy, when the level of income is going on up, going on increasing, the demand in economy is also will be going on increasing. At that time, the investment curve slope upwards in autonomous investment curve parallel to the x-axis. In induced investment, the autonomous, the investment slope curve slope upward. Induced investment is a profit motivated. It is related to the changes of national income. The relationship between the national income and the induced investment is positive. Decrease in national income leads to decrease in induced investment and vice versa. Induced investment is income elastic. I have already told. Inelastic means slow to react, to respond, but elastic means fast and reactive. It is positively sloped as shown here. I have already shown in the diagram. Let us see the difference between autonomous investment and induced investment. Autonomous investment is independent economic activity. Induced investment is planned economic activity. Autonomous investment is an income inelastic. Induced investment in income is elastic. Autonomous investment is welfare motivated. It is welfare motive. Induced investment is profit motive. What are the determinants, the factors which are influencing the investment function? They are 12 in number. Number one, rate of interest. Number two, level of uncertainty. Number three, political environment. Number four, rate of growth of population. Number five, stock of capital goods. Number six, necessity of new products. Number seven, level of income of investors. Number eight, inventions and innovation. Number nine, consumer demand. Number 10, policy of the state. Number 11, availability of capital. Number 12, liquidity assets of the investors. Let us see the relationship between the rate of interest and investment. An explanation of how the rate of interest influences the level of investment in the economy. Let us see. Typically, the higher interest rate reduce investment. It is very, very important for you to note. Higher interest rate reduce investment. Why? Because higher interest rate increase the cost of borrowing and require investment to have a higher rate of return to be profitable. Okay? It's very, very important, children, for you to understand the relationship between a rate of interest and the investment. Let us see in this diagram the difference between the higher rate of interest and the investment. That is nothing but if the rate of interest is going on increasing, investment can be made in less. If the rate of interest is going on decreasing, we have to invest more to get more profit. That one which has been explained in the diagram. Okay, let us see. As the real cost of the borrowing rises, fewer investment projects are profitable. If interest rates rise from 5% to 8%, then we get a fall in the amount of investment from 100 crores to 80 crores. If the rate of interest is going on increasing 5% to 8%, it is easily, we can notice that the amount of investment from 100 crores to 80 crores, it is falling. Okay. If the interest rates increase, then it will be tend to discourage the investment because the investment has a higher opportunity cost. Okay. A person who is investing at the rate of 5%, he has to invest 100%. At the rate of 8%, if the business people are getting interest rate, they can invest not 100%, 80% they can invest. So you can see with a higher rate, it is more expensive to borrow money from the bank. This is just opposite. If the rate of interest is going on increasing, it is very difficult for us to get a loan from the bank. Okay. Then at that time we will be getting only 80%. If the rate of interest is very less, we can get a more amount from the bank. Saving money in a bank gives a higher rate of return. Therefore, using saving to finance investment has an opportunity cost of lower interest payments. If the rate of interest is high, firms will need to gain a better rate of return to justify the cost of borrowing using savings. Okay. Thus, we have seen the interest rate and the investment, how it differs in the diagram. Now, let us see, according to Keynes, what he is telling us. However, Keynes contended that business expectations and profits are more important in deciding the investment. He also pointed out that investment depends on MEC, marginal efficiency of capital, and the rate of interest. Private investment is an increase in the capital stock, such as buying a factory or a machine. The marginal efficiency of capital, MEC, takes the rate of return on an investment project. Specifically, it refers to annual percentage yield output earned by the last additional unit of capital. If the marginal efficiency of capital is 5% and the rate of interest is 4%, then it is worth of borrowing at 4% to get an expected increase in output of 5%. Okay. Um, Thank you, children. Have a nice day. See you in next topic.